Hi everyone. In this video we'll continue working on the Chapter 8 review exercises that we started in the last two videos. In the last video we finished problem number 4, so let's go on to number 5. Smith's Company owns a machine used in their business that had original cost of $47,500 and has accumulated depreciation of $33,920. Prepare the journal entry to record the sale of the machine for $15,000. As you learned from the Chapter 8 instructor video lectures and from the textbook, the gain or loss on the sale of an asset that has been used and depreciated by the business is calculated by proceeds minus the book value. And the book value is cost minus accumulated depreciation. And if the proceeds are greater than the book value, then you have a gain. If the proceeds are less than the book value, then you have a loss. So in this case, the proceeds are $15,000. The book value is calculated as the $47,500 cost minus the $33,920 accumulated depreciation. So the book value is $13,580. $15,000 proceeds minus $13,580 equals a gain of $1,420. So the journal entry to book this sale then is to debit cash for the $15,000 cash received. The machine is no longer owned by the company. It's gone. So we have to remove the accumulated depreciation from the books. Accumulated depreciation is a contra asset account with a normal credit balance. So to remove it from the books, we need to debit accumulated depreciation dash machines, $33,920. We don't have that machine anymore, so we need to remove it from the books as well. That's an asset. So credit machines, $47,500. And we had a gain on the sale, so credit a revenue type account, gain on sale of machines, for $1,420. And that's the journal entry to record the sale of this machine at a gain. Well, you've been working pretty hard in these study guide videos, so let's take a bonus break. I will award 5 bonus points to the first 20 students who send me a picture of a very pretty butterfly. The prettier the picture, the more it's going to make me smile. And you need to send me that picture by the due date of exam number 3. Okay, let's go on. Question 6 says, use the same facts as number 5 above, except the machine is sold for only $8,000. So we still have a machine that cost us $47,500 and has accumulated depreciation of $33,920, but the machine was sold for $8,000. Go ahead and do your calculations to calculate the gain or loss, and then write the journal entry for the sale of that machine. This time we calculate a loss. The proceeds were $8,000 minus the book value of $13,580. That's the cost of $47,500 minus the accumulated depreciation of $33,920. $8,000 minus $13,580 equals a loss of $5,580. Debit cash for the $8,000 of cash received. Again, debit accumulated depreciation dash machines, $33,920 to remove it from the books. And credit machines, $47,500 to remove the cost of the machine from the books. And debit loss on sale of machine, $5,580. So debit cash, $8,000. Debit accumulated depreciation dash machines, $33920. Debit loss on sale of machines, $5,580. And credit machines, $47,500. Problem number 7 is a depletion problem. On March 8, 20X1, Billings Mining Company purchased a tract of land for $3,625,750 for an ore deposit in the land containing what they estimate to be 1,725,000 tons of ore. Billings expects the land to be worth $400,000 after the ore is mined. During 20X1, Billings mined and sold 215,600 tons of ore. Prepare the journal entry to record depletion expense for 20X1. Go ahead and calculate 20X1 depletion expense, and then write the journal entry to record depletion expense. Then start the video again to check your work. As you learned when you watched the instructor video lectures for Chapter 8 and while you read the textbook, depletion is calculated in a manner very similar to units of production depreciation. It's cost minus salvage value divided by the total quantity of natural resources that is contained in that asset. In this case, we are estimating 1,725,000 tons of ore in this land. So 3625750 minus $400,000 salvage value divided by 1,725,000 tons of ore equals depletion expense of $1.87 per ton of ore that is mined and sold. In 2000X1, the company actually mined and sold 215,600 tons of ore times $1.87 a ton equals depletion expense of $403,172. Debit depletion expense, $403,172, and credit accumulated depletion, $403,172. And the last problem in this study guide is an amortization problem. On April 1st, 20X1, Smart Products paid $252,000 for a patent on a manufacturing process. Smart Products expects to use the patented process for 15 years. Prepare the journal entry to record the amortization expense for the month or for the year ended December 31st, 20X1. And amortization expense is calculated in a manner very similar to straight line depreciation, except never, ever do you use any salvage value with respect to amortization. So the patent will be amortized over the shorter of its legal life or its expected life. The legal life for a patent is generally 20 years. The expected life is less than 20 years, only 15 years in this problem. So we're going to take the $252,000 of cost divided by its expected life of 15 years, and that equals $16,800 of amortization expense per year, and of course a year is a full 12 months. In 20X1, we have only a partial year. We use the patent for 9 months, April through December. So $16,800 times 9/12, which would be the same thing as taking $16,800 dividing by 12 and multiplying times 9, and that equals $12,600 of amortization expense for 20X1. Debit amortization expense, $12,600. Credit accumulated amortization, $12,600. Well, that's all for the Chapter 8 study guide. See you next time for Chapter 9.